Welcome back to the Relocation Rundown. I'm Aaron,
I'm Geoff.
and we are the Aaron and Geoff team at Compass, your New York City real estate experts.
So we are talking to one of my favorite people, Adam with CliffCo Mortgage. Adam Turkewitz, thanks so much for being here. This is an interesting episode for us because usually we're talking to different real estate agents in different markets,
Yeah.
but there's so much conversation recently about interest rates. And I think that there are people who don't have a foundational understanding when it comes to mortgages and lending, no matter where we're talking about. So I wanted to talk to you about this specifically. So welcome to the pod. And before we jump in, can you give us a little bit of a bio and insight on who you are?
Sure. Well, first off, thanks for having me. I'm excited to be here. My name is Adam Turkewitz. I'm with CliffCo Mortgage Bankers. I've been in the mortgage business for 21 years. I've done a little under $4 billion in residential mortgages in my career. I'm licensed currently in 31 states. The majority of my business tends to be located in the New York City market, the Hamptons, Long Island, Lower New York, Northern Jersey, Florida. So that's really the bulk of where my business really takes place. And one of the things that I really specialize in is I love working with first-time home buyers, and I love working on complicated deals.
When you say
Don't we
complicated
all?
deals, tell me more about that.
Yeah, I mean, I love to work on deals that other mortgage banks can't figure out. Mortgage over the last 20 years of doing this has really become very commoditized. It's kind of like a one box fits all, or one size fits all in the same box. Being where I'm at CliffCo, I have a lot of latitude in terms of trying to find creative solutions for a lot of our clients that may be hamstrung at a lot of other banks. So it really sets me apart in a business that has really become very commoditized.
So let's get down to a foundational level about what financing is, right? What do people need to know about lending when it comes to different states and when they're looking at making a relocation?
Yeah, I mean, I think that one of the biggest things that tends to shock buyers that are buying in the New York market specifically is the expense of buying in the New York City marketplace, right? New York is a very expensive place to buy real estate in, both from a price per square foot relative to the rest of the country, but also from a closing cost perspective. And a lot of people that haven't grown up in the New York market, they don't realize that. They don't realize that when you spend $1 million on a property, you're going to get a mansion tax, right? And people don't associate a studio or one bedroom apartment that's $1 million as a mansion. But you get hit with this tax. There's also taxes, for taking out a mortgage. Sometimes if you're buying new construction, you could be paying the transfer tax, which is extremely expensive. Between all of the taxes and the insurance for title, that tends to be the biggest sticker shock and surprise to a lot of buyers coming from out of state into the New York market.
What about looking outside of the New York City market, right? I know you work outside of this area, though this area is your specialty. Is there something that you think people on at least a basic level should understand about what they should be doing as far as getting financing for a purchase?
Yeah, so regardless of where you're buying nationally, whether it's, here locally in New York City or whether it's in the suburbs of Connecticut, it really doesn't matter where you're buying. You need to start getting your affairs in order about 90 days prior to really looking for a home and putting in an application. And I say 90 days because, in my experience, what happens is when a bank looks at documents, we're generally looking at the last 2 months of documents, right? If you start 30 days before coming to a bank, you start moving money all over the place. It creates a lot of chaos in the mortgage underwriting process, right? Because every time you move money from one account to another account, we have to source where that money went, right?
Mhm.
We can't just take your word for it. We have to document where it went, where it came from, who it came from, what it was for. So to the extent that home buyers are able to move the money around to where they want it 90 days before they apply for a loan, then that movement will cycle 30 days, and then the statements become available. And now we have 2 months of statements where the assets are just kind of sitting there pretty dormant, and it creates a much better experience for the customer. Of course, not every customer is going to be able to do that. There's always going to be money moving around, but to the extent that we can limit the movement of money, it does create a much, much better process for the buyer.
Before we go any further, I know you're with CliffCo Mortgage, which is slightly different than like going into a Chase or a Wells Fargo for a mortgage. Can you just kind of like tell us what the difference is between you and like going to get a mortgage at your local bank?
Sure. So when we do like a conforming loan, right? So think about a mortgage that is $806,000 and less, right? That's a loan that generally gets sold off to Fannie Mae or Freddie Mac. Whether you're coming to me, whether you're going to a bank like Chase or Wells Fargo, that loan is ultimately going to be underwritten to the credit policy of Fannie Mae or Freddie Mac. Okay. When you come to me, you're getting the raw credit policy. So if Fannie Mae says that we can lend to you with a 620 credit score, we can lend to you with a 620 credit score, right? If Fannie Mae says we're okay with 1 year of business tax returns, we're okay with 1 year of business tax returns. When you walk into the door of some of these ivory towers, at some of the larger banks, they have what's known as a credit overlay, right? So they say, even though Fannie Mae says we're okay with a 620 credit score, XYZ Bank, we want to see that the credit score is at least 660. So they made it harder for that buyer, even though that loan is being sold and going to land at Fannie Mae, they've made it harder for that buyer to qualify. They may say to a self-employed borrower, we know you've been self-employed for the last 5 years. We know you filed last year's tax returns. We still want to see the most recent 2 years of tax returns and a current year profit and loss statement. That's another credit overlay, right? Because the way Fannie Mae's policy reads is when you're self-employed and you've been self-employed for at least 5 years and you filed last year's tax returns, you only need the most recent year's tax returns. You don't need two, and you also don't need the profit and loss statement for the current year. That's another way where it makes it easier to obtain the financing coming to a space, a company like mine. So that's on the Fannie Mae and the conforming side of the business. But there's a whole other side of the business that when I came to CliffCo Mortgage, my eyes were made wide open to, right? And that's this part of the business that's really geared towards self-employed borrowers, entrepreneurs, such as yourselves, as well as real estate investors. And what I found in this space was when I was at my prior lending institution, one of the biggest frustrations that I would have is I'd come across really, really strong borrowers, but their tax returns didn't tell the whole story. They had creative tax strategies, or they were writing a lot of their income off to limit their taxable income, right? And then it caused an inability for the big bank to be able to approve that loan. When I came over to CliffCo Mortgage Bankers, one of the things that I found was I'm able to help a lot more entrepreneurs and real estate investors because we take a different approach to qualifying the income. Instead of taking a look at a tax return, which we can do, right? But instead of taking a look at a tax return, which is really just showing how creative is your accountant to limit your income to lessen your taxes, right? We're able to take a look at things like the last 12 months of your bank statements for your business and really see what's the revenue that's coming in and what are the real expenses that are going out. And more times than not, using that approach gives us the ability to approve a buyer for more than a tax return would generally allow for, because we could see the actual revenue coming in, right? We could see how the business is operating, and we could see how the business is operating almost in real time, right? Because I'm looking at the most recent 12 months of statements, not a tax return that's from, at this point, 21 months ago.
Right. And it's interesting because I've heard from other lenders who I've spoken to about self-employed borrowers, and the perspective I've heard before is, you might just have to kind of bite the bullet and pay the tax man for a year or two before you want to buy a primary residence. And,
I don't want to do that.
I don't want to do that. And that hurts, right? As somebody who's trying to save to do a home purchase, I'm trying to, as a business owner, write off as much as I can that in a legal sort of way. So it feels interesting to hear that there are other kind of strategies out there. But it leads me to the question of how do you qualify buyers for a mortgage? And I'm also curious because in our market, so often we're dealing with co-ops and they have a very different kind of qualification process. How do you look at things differently than the co-ops do?
Right, so let's put co-op to the side for just a moment, right? Because part of our marketplace and a good part of our marketplace is co-op, but also a big part of our marketplace are condominiums, multifamilies, where the co-op layer doesn't affect things, right? First and foremost, if we can use a tax return to qualify the client, then we're absolutely going to use the tax return to qualify the client because that's where you're going to get the best terms for your mortgage, right? The best rate, the best leverage, and the absolute best terms. But to your point, there are many times where you look at a tax return for an entrepreneur, somebody that's self-employed, and the tax return just shows a loss. Maybe it shows not quite enough income to qualify for the size loan that they're looking for. And so again, normally what we'll do is if we can't qualify them using a tax return, then we'll jump into something else like send me the most recent 12 months of bank statements. We take a look at it. We run our formulas to see where we feel the income is. And then we come back and say, okay, based on our analysis of the bank statements for your business, we feel that the income is X. Does this feel a little bit more in line with where you feel your income is? More times than not, they say, absolutely, you're pretty spot on with that. Now, when you look at a lending program like a business bank statement program, it is going to come at a premium, right? The interest rate is going to be higher because it's a more non-traditional way of approaching underwriting that loan, right? So the liquidity in the market, the securitization pools that are out there, they're not as robust. There's not as many places that you can place those loans. So the cost of those loans are more expensive. But you brought up a good point, right? The advice that they're getting right now from the big bank is just go, file your tax return next year and just show more income, right? Well, easy to say, but think about it like this. If you're an entrepreneur and you're making, revenue of your business of say $600,000 a year, and let's say you write off $500,000 at a 30% effective tax rate, that's about $150,000 of taxes that you didn't pay. Agree? So if I then give you a mortgage at, let's say, $1 million mortgage. So I give you $1 million mortgage, and let's say that the difference in interest rate between a traditional loan and a non-traditional loan, it's typically between a point and a point and a half higher for a bank statement loan compared to a tax return type of loan, right? So let's just give the benefit of the doubt to all the doubters that are out there. Let's say it's a point and a half higher, right? On $1 million mortgage, that's $15,000 more in interest, right? So I beg the question back to the entrepreneur, would you rather go refile your tax returns and pay $150,000 in income taxes, right? Or would you rather pay an extra $15,000 in mortgage interest? Now, granted, the mortgage interest is a recurring thing, right? Every year you're going to pay that 15, but it's going to take you roughly 10 years in that example to break even to where you would have had to have been to refile your taxes. And then what, you're going to refile your taxes, and then the next year you're going to file it right back the way it was. Even if that's the case, New York City is a very transient market. So locally, the likelihood of somebody being in that home or even in that loan for 10 years is pretty low, right? The normal organic progression of home ownership in New York City is I'm going to go buy a studio or a 1-bedroom apartment. Then I'm going to sell it a couple of years later. I'm going to go buy a 1 or 2-bedroom apartment. And then I'm either going to stay there and buy something bigger, or I'm going to leave to go to the burbs, right? And maybe I'll retain it as like a second home, a pied a terre. So again, normally when you put it like that, you get on the phone with the accountants and they start to understand, why is the interest rate a little bit higher, but it's the lesser of two evils, right? Going this route, paying a little bit more in interest, better than paying more in income tax.
So, we're hearing you talk about a lot of different terms, such as buying points or points in general, right? And we've heard about buying points in other conversations with you. Can you give us some perspective on what that is, what it means, and when is the time to consider doing that?
Yeah. So what buying points means is that you're prepaying interest effectively, right? So you're paying a fee at closing, right? Typically it's a percent of the loan amount. So if you're borrowing $500,000 and you pay 1 point, you're going to pay $5,000, right? And what you're doing is you're going to buy yourself an interest rate that's below market. So by example, if the 30-year fixed rate today is 6.5% and you pay a point, you'll prepay interest of $5,000, and then you'll buy the interest rate down to maybe 6.25, 6.125, something along those lines. Typically 1 point will buy the rate down about a 1/4 point to 3/8 of a point, right? When we go through that calculus, what we're really doing to figure out does this make sense or not, we're trying to understand from the buyer, how long are you going to be in this property for? How long are you going to be in this loan for, right? As we just discussed, New York City is a more transient market, right? So the likelihood of somebody being in that apartment for 30 years, it's possible, but it's a little more unlikely, right? There's a little bit more movement from apartment to apartment, home to home in our market than there is in the rest of the country. So really what we are trying to understand is how long are you going to be in the loan for, right? You may buy the property today as as your primary home, and 5 years from now decide that you're going to keep the property, but you're going to keep it as an investment property and you're going to move to another property. So the longer you keep the loan, the more it makes sense to pay the points to buy the rate down. We run what's called a break-even analysis. So we look at what's the cost to buy the rate down, what's the monthly savings in terms of dollars, how many months is it going to take to break even, and how long do you plan on staying in the property for, right? Because there's also an opportunity cost of that money, right? If instead of taking that money and putting it towards the rate, could you put it towards paying down the principal of the loan? Could you take it and put it into an S&P 500 index and how that performs? So there's a lot of other variables that go into it, but in its most simplistic form, you tend to see the buy down in the current market. The break even tends to be somewhere around 36 to 40 months on paying that fee.
So, we're very often, and even in this conversation, we hear mortgages spoken about with 30-year terms, but we're also acknowledging that people are probably going to make a move out of that loan within 5, 7, 10 years more likely. So kind of a multifold question, are all loans 30-year terms? And if, why are we talking about things in 30 years if we're likely looking at a shorter term?
Great question. So when you look at the liquidity that's available in the marketplace and the lending options, the securitization markets are largest in the 30-year fixed rate space, right? So that's where a lot of investors tend to, create the opportunity for mortgages. So you tend to see very sharp pricing in that space. When you get into portfolio lending, so more jumbo type of lending, now those are loans that are really sitting on a lender's balance sheet. So they're not exposed to market variables in terms of like the securitization that's out there, because they're really just marking it to, an asset class internally and being able to price it, internally, right? So on a conforming loan, you can ask me for a 5-year ARM, but you're probably going to get the same rate as if it were a 30-year fix. So it really just doesn't make any sense to go with an ARM when the loan amount is like $800,000 or less, right? When the loan becomes a jumbo loan, then you start to see spread between the 30-year fixed rate and the various adjustable rate mortgage products, which primarily in the marketplace are the 5-year ARM, the 7-year ARM, and the 10-year ARM, right? They're all 30-year loans, but the rate is either fixed for 5, 7, or 10 years, and then the rate adjusts thereafter. And what you generally see is the spread between the 30-year fixed rate and the 10-year ARM is typically somewhere around a quarter to a half a point, depending on compression in the market, appetite out there, with the investors. And then between each ARM product, so from the 10 to the 7 to the 5-year ARM, you tend to see rates move about an eighth to a quarter point in rate between products. There's also another interesting product that's out there, which is called a 40-year fixed rate mortgage. So again, it's one of those products that is available to help combat home affordability, right? In our marketplace, home affordability is something that we battle on a daily basis. So stretching those payments out an additional 10 years, it helps bring down the mortgage payments a little bit to help that first-time home buyer get into the property and manage their payments.
Um, if you were advising someone who is preparing for a home purchase, what would you recommend they do to get ready to go?
All right. So first thing I would do is I would have them check their credit score by going to freeannualcreditreport.com. Make sure that if there's anything that's delinquent, derogatory, reporting on credit, they figure out what's going on. Yeah, they figure out what's going on with that. Why is it there? Maybe it's a mistake. I speak to, hundreds of clients a year, and, some clients that seem to be the most qualified clients, there's a $25 medical collection reporting on their credit report because they took a kid to the doctor. Geoff had other reason for the kids, but they took a kid to the doctor and they forgot to make the copay of $25, and it kind of slipped through the cracks, and boom, now it's sitting on your credit report as a collection account, right?
Shout out to our siblings for letting us be uncles instead of parents.
There you go. There you go.
That be on your credit report.
So I'm just forgetting about my own copays, not the kids.
Right.
But even your own copay, right? So it's really checking out your credit, right? When you're about 90 days away from applying for a loan, try to really limit the amount you're putting on your credit card to not exceed 10% of the limit that you're given, that you're afforded. So if you have a American Express credit card that allows you to spend $10,000, right? That's your limit. Then try to keep your spend on that card to under $1,000, under 10% for those 3 months, right? When you make a payment on your credit card, it doesn't automatically report to the credit agencies. Every time a creditor reports to the credit agencies, it costs money. So it's not this living thing that is moving every day, every second, every minute, right? When you spend money on it and when you pay your credit card off, it doesn't update in real time. So creditors have a set day in the month where they typically will report to the credit agencies. Maybe it's the 10th of the month, maybe it's the 20th of the month, but they typically have a set day. And what I tell my clients is call your lender, call your creditor, find out what that day is, right? If they report on the 10th of the month and you have a $5,000 American Express bill and you pay that off on the 11th of the month, American Express just said that you have a $5,000 bill, even though you paid it off on the 11th and I pulled your credit on the 12th. Whereas if you made your payment a couple days earlier, right, you paid it off to 0 on the 9th, and now on the 10th they report, on the 11th they pull your credit, now your credit is going to look very different, right? So understanding when your creditor reports, very, very helpful. So that's the first thing on, yeah.
There, right? If, because the idea of not spending on my card sounds impossible, right?
We put all of our expenses on the card.
Everything goes on our credit card.
But we pay it off every month.
So the idea, I guess, instead of not spending on the card would be maybe make my payments on the 1st for the few months. That way I know it's like in at the top of the month and it's, it'll look clear for the statement report.
Well, yes and no, right? Because if you paid off on the 1st of the month and they report on the 10th of the month, and on the 2nd, 3rd, 4th, 5th, 6th, 7th, 8th, and 9th, you're spending on that credit card, right? It's showing the balance. My advice is this, right? I know it's hard. I know how American public, lives. They use their credit card, then they pay it off and everything else. If you're paying it off at the end of the month anyway, you're telling me you have the money in your account, right? If you're not paying it off every month, then you don't have the money and you're living probably a little bit outside the means, right? But if you're paying it off every single month, then my advice would be in the 90 days leading up to getting a mortgage, just behave a little bit differently with your credit, right? Instead of putting it on the credit card, put it on the debit card. You're paying it off anyway. The money's in the account, right? It's not a complete change in lifestyle for the next 20 years. It's a change in lifestyle for the next 90 days, right? It's to help get you a better interest rate, which is going to save you more money over the next 5, 10, 30 years, right? So if you can't do that completely, try to do it 20% of the time, 50% of the time. But if you can bump your credit score up the next tier, it'll help you get a better interest rate, which is going to help save you more money every month for the next 10, 20, 30 years, right?
Where does your credit score stop mattering? Like at a certain point, like where does it matter between like a 750 and a 800 plus?
Yeah, so it really depends on the lender and the type of loan that you're going for. The top tier is anything over 800. So credit goes to 850. Anything over 800 generally is going to get you that premium rate, that best rate that's out there, right? Once you're over 740, 760, you're still getting a really, really good rate. And when you go below 740, you start to see the pricing on your loan start to be a little bit more impacted, right? What goes very hand in hand, the higher the leverage you take, so an 80%, 90% loan to value, married with a lower credit score is very, very detrimental to the interest rate you're going to get. Whereas you could have a little bit below average credit score, right? Say it's 720, 715. But if you're putting down 30%, that's going to help offset the risk of the loan. And so your rate actually may be similar to somebody that has a 740 credit score at 80% financing. So putting down some extra money can help offset some of the risk on the loan and get you into better terms.
So if I'm looking at my credit report and it's telling me I'm an 810 and I'm getting ready to buy a home, I don't really have to adjust my spending habits. I'm good to go.
You're a stud. Keep it up.
Oh, you're a stud.
I haven't checked my score in a while, and that was Credit Karma. So I don't know if it's right.
But that's all fun. It's check your credit, right? Go see what your credit score is. A lot of banks give you the opportunity when you log in to look at your balances. It'll give you like a free credit score. It's not always accurate in terms of how a mortgage lender will look at your credit, but it at least gives you an idea directionally. Do you have really good credit, or do you have things that you need to work on, right? So credit is really that first thing that I would always look at, because it's going to be the primary driver in the terms that you're going to get for your loan. The second thing is going to be, and we talked about this before, it's making sure you limit the movement of assets, right? Try and keep things concise. If you have 5 different savings accounts, try to consolidate them to one, right? It's that much less paperwork that the bank needs to look at. The less paperwork the bank needs to look at, the less complicated the loan becomes, the faster the turn time is going to become in underwriting, the better experience the buyer is going to have, right? So there's little things like that. And then it's starting to get your documentation in order, right? Generally, the bank's going to want to see 2 years of W-2s, a month of pay stubs, 2 months of bank statements. That's the meat and potatoes of kind of what makes up the loan application documents. So to the extent that you have all that put together, and when you look at your bank statements, if you see a transfer going from your Chase checking account to your American Express savings account, right? I could see that. My underwriter could see that. It's pretty easy to source that. But if Aunt Jane is giving you a $3,000 gift and then you just deposited $20,000 in cash, right? Those are things that you have to document, where we have to understand, where did that money come from? How can you document to us that that cash came to you because you sold a car, right? Or that Aunt Jane gave you a gift, right? There's additional documentation that needs to happen. So it's really trying to connect the dots and try to avoid doing things like that that could impact your ability to get financing. A lot of people, believe it or not, even in this day and age, they still literally have cash under the mattress. And then they start depositing it into their accounts in the weeks and days leading up to their mortgage. We can't use that. We can't use cash under the mattress. So start getting it into your account so that it sits there, and we can start to use that as an asset for qualifying a loan.
There seems to be a lot of different products out there, right? How does somebody who's never interacted with lending like this begin to try to navigate understanding what's the right product for them?
Yeah. I mean, there's a lot of order takers out there in the mortgage business, as I'm sure there are in the real estate business, right? Would you like to biggie size that for, extra $2? I don't tend to think of myself as like a loan officer. I try to think of myself more as like a mortgage advisor. So really, when you have a customer that emails you and just says, hey, what's your rate for the 30-year fixed rate, right? Those are like the worst customers. They are. It's like somebody emailing you and saying, hey, what's the price of a studio apartment on the Upper West Side? Right? Well, there's a lot more that goes into giving you that answer, right? So for me, it's getting to know the client, right? Getting to understand, why are they buying this apartment? How long do they plan on staying in the property for? Are they going to have any liquidity events over the next couple of years, right? Maybe there's an imminent inheritance that's coming their way. Maybe there's a large bonus that's going to get paid out. Maybe there's restricted stock at their company that's going to start to vest, right? Other liquidity events that are going to happen, and your plan is to pay that loan down aggressively, right? It's really important to understand that, because to your point, we then start to look at perhaps different types of loan products.
Right.
What's your income, right? If you're a high earner, which New York City is filled with high earners, maybe a 30-year fixed rate isn't the right product for you. Maybe we go to a 20-year fixed rate, a 15-year fixed rate, which is going to get you a better interest rate and save you potentially tens, if not hundreds of thousands of dollars in interest back to the bank, right? So understanding your income potential, liquidity events that are about to happen, it really starts to drive the type of loan that you can qualify for, right? So I try to spend a lot of time with my buyers to really understand not just what's happening right now, but is there anything happening 6 months from now? I start to ask those probing questions to then say, yeah, I know you're coming to me for a 30-year fixed rate because that's what your parents told you is the best thing to do, but let's also explore other options, right? At the end of the day, if we decide a 30-year fixed rate is best for you, then that's great. But you as the consumer need to understand that there's a lot of other options that are out there that might be a better fit for you in your situation.
Getting a little more local, can you tell us about some unique financing opportunities in New York State, New York City?
Yeah, I mean, in New York State, you've got Sonny Mae, which is a great opportunity. Fannie Mae with multifamily, they allow for 5% down. You have a lot of grants that are out there. There's a lot of programs that are geographically pronounced, where depending upon where the actual property is, you might be able to qualify for a special type of mortgage program. There is income-driven programs that are out there. Just because you see the advertised rate for a 30-year fixed rate at 6.5%, it doesn't mean that there's not another option that's out there that has, a 5.875%. just because of where that property sits. When we start looking at the properties, and I have clients sending me addresses of where they're looking at, one property may be priced higher than another property, but then we start to look at, hey, this particular building that you're buying in, it qualifies for this particular lending program, and the interest rate is 3/4 of a percentage point lower than the average 30-year fixed rate. So even though this is a little bit more expensive as a purchase price, it's going to cost you a little bit less because the mortgage amount, right? So we start to really have that type of dialogue. And there's great programs out there, right? I mean, again, FHA, 3.5% down, for our veterans who I love, right? The VA program, 0% down, 100% financing for our veterans. So there's a ton of really, really great programs that are out there for all different walks of life and types of buyers.
Now, this is a relocation show, and you did make the big move out of New York City a few years ago. So, what advice do you have for people moving out of New York City to a totally different place hours away?
Yeah. Well, so I still commute to the city um pretty regularly, right? I live out on Long Island. I think, it's really important to understand what are your expenses going to be, right? So I was living in a two-bedroom apartment on the Upper East Side with my wife and my 1-year-old son when we made the move out of New York City to Long Island about 12, 13 years ago, right? And being a mortgage professional, I was able to calculate my debt ratio, make sure everything felt comfortable. But what you don't tend to take into consideration, is, if you're going to hire a landscaper, right? Like the weekly cuts that are coming, the pool guy, because I am so not handy, I can't swing a hammer, uh, let alone figure out how to clean the pool every day. Uh,
Yeah.
Sure.
Swinging a hammer, something breaks in the house, right? Getting a handyman, to the house, because again, I'm not that guy. That's going to be able to fix anything. My kids make fun of me for it. If something breaks in the house, and they don't even come to me, they just call Poppy, right? And Poppy comes to the house and fixes it and makes me feel about this big.
Yeah.
Nice.
So it's all the incidentals that come with buying a house, right? It's, if the roof leaks, making sure you get a good inspector to the property so that you understand what are some of the deficiencies of the property. Every property has it, right? If you're going to go and get an inspection report, it's going to come back with something, right? You get a full body scan, no matter how healthy you feel you are, it's going to find something. Always going to find something. So really what it is making sure that you're comfortable with the condition that the property is in, right? Like when I bought my house, I had my home inspector come out. My home inspector told me, your roof needs to be replaced like yesterday. It didn't stop me from buying the house, right? I love the house that we found after literally 4 years of looking. That wasn't going to be the impetus of me not buying the house. But what I did do is I went back to the seller and I said, hey, here are some of the things that are of concern, right? I still want the house, but I think we should negotiate a little bit more on a couple of things. I was very reasonable. The seller, was very reasonable. I actually speak to the seller to this day still. We remain friends, and again, I was able to get myself a little bit of a better deal than I originally got an accepted offer. But I remained reasonable through that process because at the end of the day, my wife and I, we still wanted the house.
What are the questions that you wish your customers or clients would ask you that you don't get asked often enough?
That's a good question. We're pretty thorough on our calls, right? By the time we're done with our first call, I mean, not only do our clients have an email from my team where we follow up with kind of the summary of what we talked about, and we give them a breakdown, like a financial breakdown of the loan structure. So by the end of the call, like there's not a lot of questions that are outstanding. I think the biggest question that I wish my clients would ask when they come to me and they say, hey Adam, I'm getting quoted a rate by another bank and the rate's a little bit lower than yours, right? You know, can you match it, right? It's a valid question, but what you tend to see in this marketplace is lenders are quoting rate and they're being a little deceitful in the sense that they may quote a lower rate, but then leave off that there's points with that rate, right? So hey, I can get you a rate of 5.5% on the 30-year fixed rate. Adam, why is your rate 6.25%? Well, I'm not charging you points. I can charge you points and buy your rate down, but that other lender that you're talking to, they're probably charging you points for that rate because at the end of the day, you're really never going to see a very large discrepancy in pricing. right? Could a lender be an eighth off, a quarter off from day to day? Of course they can, right? But it's very rare that you see a half a point spread, 3/4 of a point spread. And when that happens, generally what's happening is they're getting quoted that rate with points and they don't know it. So I wish when a client comes to me and says, "Hey, Adam, I got quoted this," I wish they would have gone back to that other lender and asked the question, "Okay, that sounds like a great rate. Is that with no points, right? Is that with a 30-day rate lock, a 60-day rate lock?" These are things that are going to impact pricing on a loan. So really understanding what the rate lock period is and does that rate come with points? If they had that information, that would be very helpful. When I am finished with a call with a client, and again, I send them an email, so I summarize everything, there's an analysis that I provide them, and I give them 4 options to look at. And it gives them a break-even analysis, and it gives them a rate with no points, partial points, full points, all the way through. And there's 4 options that they get to look at, so that if they're comparing it to another lender, it hopefully puts a light bulb that goes off and says, "Okay, this guy's giving me a lot of really good information. It's very transparent. It's black and white. This person gave me a quote over the phone, and for some reason they refuse to give it to me in writing." Again, I try to be very transparent with clients so all the questions are taken off the table.
To echo you just there, this guy's given us a lot of information today. Adam, thank you so much for taking this time and giving us this kind of crash course in mortgages. Do you want to, shout out where people can find you and get more information on you?
Yes, if you just Google my name, Adam Turkewitz, and CliffCo Mortgage, CLIFFCO, I'll pop up. Feel free to reach out. My cell phone number is 917-574-6040. Just like Aaron and Geoff, I'm pretty 24/7, 365. So anything that you need, give me a call. Weekends, holidays, I'm always here to help.
Perfect. Well, I'm Aaron.
I'm Geoff.
And this has been The Rundown. We'll see you next week.